The other thing that's critical to understand, and it has two sides to it, is what's called the W. Arthur Lewis effect. W. Arthur Lewis was a Jamaican economist who received the Nobel Prize for his work on development. And what Lewis noticed was that most developing countries, because they hadn't grown, have huge piles of labor that is underutilized to the point of being almost redundant. And most of it's in agriculture. And so if you actually watch the dynamics work, what happens is that new businesses are created initially in the export sector. They are sold into a gigantic global marketplace. So think of it this way. Are you going to face a downward sloping demand curve if you're a small country? Answer, no. If you've got 1% market share in the global economy because you're small and you grow real fast and get to 2%, big deal. No price is going to shift much against you. And the only country that has ever gotten big enough and still in developing country status to actually drive down the prices in the global market is China. China actually turned the terms of trade against themselves by driving down the cost of certain kinds of manufactured goods, and now they're busy driving up the cost of a whole bunch of commodities as well. They'll survive, don't worry about them, but everybody else has the advantage of being tiny, so demand is essentially unlimited. Well, what about supply? It's assuming that you can get the investment rates up. Well, most of the supply is labor that you need. It's the other critical input. So if you manage to educate them reasonably well, and you start this engine running, the opportunity cost of deploying labor, in the modern economy that you're creating, that's the basis for the growth, is next to negligible. And you can see this. You take people, millions of people out of the agricultural sector and deploy them in the modern economy, initially with a heavy emphasis on the export sector, in areas where you have a comparative advantage in labor-intensive things. Does agricultural output go down? No. Now, you don't very often find a place where you can take lots of labor out and have no effect on output. The opportunity cost of labor is zero in an early stage developing country. Now, that doesn't last forever, but while it lasts, the model, if you think about it in sort of quasi-mathematical terms, is linear. There's no limits on the demand side, and there's almost no limits from the supply side marketplace either. And so basically, you can grow as fast as you can efficiently invest. And that turns out to be around somewhere in the 40% of GDP. Most countries don't get up to that level. That's the dynamics. Very briefly, China and India. China's about 14 years ahead of India, and they're following essentially the same growth path. These numbers are a bit out of date, but you can see if you want to make your best guess on tracking India, just in quantitative terms, just drop back 14 years and follow China. These are the investment rates. They just illustrate what I've already told you. They're high, and they're normally funded with domestic savings. Now, I don't know how many of you are, spend a lot of time on national income accounting. But if you don't fund it with investment savings, then you're running a trade deficit, or more accurately, a current account deficit, which means that you're importing savings from around the world to finance your investment. In theory, in economics, there's nothing wrong with that. In practice, it's dangerous, it turns out. And so almost all the cases we can find of sustained high growth involve very high savings rate. And that helps you understand why not every country gets started. If you need to say, just to take a round number, 30 or 35, let's take 35% or a third of the GDP in order to sustain a growth rate, an investment rate of a third. And you think about this, if the per capita income is $500, then you're not consuming on your daily needs a third of it, right? Well, that's an enormous sacrifice. I mean, we don't think of it that way because it just isn't relevant to us. So most countries don't get to do that. The political process prevents the public sector investment levels from rising because it's too costly in terms of daily life now. And then the private sector returns aren't high enough and the engine doesn't start. Okay. Literacy is important. That will not surprise you. China is a complete outlier. In the West, the Communist Party is much criticized for lots of different things and with lots of good reasons. But one of the things they did, and this precedes the high growth phase that started 30 years ago, is they educated everybody, men and women. So there's two things striking about this. One is the length of the bar, and the second one is the small difference between men and women in China. Now, that doesn't mean, there's no discrimination, but this kind of growth, therefore, presents longer-term issues because the emerging economies are within a decade, even at current exchange rates, from going past 50% of global GDP. And then from here on, it's a story in which they increasingly become the dominant part. So pick any dimension that you're interested in: governance, carbon emissions, energy consumption. Pick any one, and all the growth will be associated with the emerging market, increase in economic mass. And so increasingly, almost all of these things are perceived as global issues. Are actually issues that are both created and have to be dealt with by the pattern of that growth. Now, I'll tell you a surprising thing, just as an aside. My last trip to China, which was about a month ago, I started listening to people, and I heard something I'd never heard before, which is the following. In China, and in Asia generally, a little less so in India so far, they've realized that what we used to think of as a global issue, take carbon emissions, where everybody's a free rider. I mean, in Europe here, if you listen to Germans, they say, quite rightly, well, we're busy doing this. The only effect of that, if nobody else does anything, is we'll have a very warm planet and we'll have a competitive disadvantage because we impose costs on ourselves. I mean, there's other versions of that story that are more benign, but that's the idea. The Chinese have realized that their growth actually cannot reproduce all their predecessors. And so what we think of as a global issue for them is a growth strategy issue. It doesn't matter what we do. They can make their growth unsustainable all by themselves, just by doing it the wrong way. And now the verbiage around this is, we're going to have to change our lifestyle. And I heard it over and over and over again. And what it means is we're going to have to change the energy intensity. We're going to have to change the design of cities. We're going to have to change the transport systems. And we don't know how that's going to come out. But the interesting new development is that these countries are now at a size where they can foresee that they're the main event. And what used to be an international issue where you have to negotiate, and most of us think probably won't work, is actually now going to be concentrated in their backyard. Impact of the crisis. I won't spend a lot of time on this. The Growth Commission worried that the emerging economies would interpret the crisis in the advanced economies where it emanated, especially in the United States, as a massive failure of the system they'd adopted, which is a market-based system with capitalist incentives. And that would have been a very great shame because it would have truncated the kind of policies, and the people who wanted big states and and oppressive interventionist policies would have won. That's not what happened. They correctly interpreted it, I think, in the end, based on the evidence in the last couple of years, as a massive failure in the financial system, which we're all still trying to figure out, but not that. The developing countries, I'm sorry, I'm going to skip that. What that slide is about, for those of you who looked at it after it, are lots of controversial areas that have to do with policy in developing countries. I didn't want to leave you with the impression that this was kind of a simple kind of cookbook thing. And so export promotion, industrial policies, how fast to open up the economy on the current and capital account are all issues that are up in the air, that are debated, sometimes divisively and so on. And these folks don't get to sort of wait for the academics to settle it. They just have to make their best shot based on benefit risk analysis and so on. Decision making under uncertainty. How were the emerging economies affected by the crisis? there were two channels. One, capital that had been flowing into these countries flowed out because of damaged balance sheets, particularly in Europe and North America. And it flew out at a very high rate. This caused an instant credit tightening in these countries. Interest rates started to shoot up. Credit wasn't available, and they had to intervene extremely quickly in order to prevent this outcome, and they did. And that's part of the reason I say that they have become very much better at sort of macroeconomic management and monetary policy than in the past. I don't think anybody in 1995 would have bet that with a crisis of this magnitude and this unexpectedness would be responded to in this way. Just a very impressive performance. The second channel was trade just fell off a cliff for reasons I could speculate about, but I think we're only barely starting to understand. But the trade drop globally was way bigger than the GDP drop. I mean, on the order of like 25%. And so maybe it's durables that tend to go down more. Maybe it was trade credit. I don't know. I mean, there's lots of little bits and pieces. Why did they survive so well? Answer, they had domestic ownership of their financial institutions. So when the BCE and the United States Federal Reserve took over the financial institutions and deployed their assets in the interests of wherever they were, they had people to work with in the private sector or quasi-private sector. Some of them are state-owned or partly state-owned. They had very rapid responses by the central banks. The trade bounced back, or they would be in trouble, in part because intra-emerging market trade bounced back very fast. They had reserves that they had accumulated for 10 years, starting in 1998, and that was their form of self-insurance against the kind of balance of payments problems they had in 97, 98. And they were criticized every single year by the IMF and the World Bank for accumulating these reserves. Very inefficient form of insurance. The problem was that the international ones, where you pool risk, don't work. And even if they do work now, they didn't believe they worked, right? Remember in 97, well, I don't know, I shouldn't say remember, I don't know how many of you know what happened in 97, 98, but the IMF, went in and said, we'll lend you money, but here are the following 265 conditions. There's a famous story. Indonesia was one of the hardest hit. And the IMF worked out a package of loans to tide them through, and tied to it was a document this thick that specified how they had to manage their economy. And the then Prime Minister of the country came to a signing ceremony with the director of the IMF, and the director of the IMF said, do you want to read it before you sign it? And the Prime Minister said, would you change anything if I read it? And the director of the IMF said no, and then he said, I don't have to read it, do I? And to this day, the Asian countries will not deal with the IMF, even if they're in trouble. The IMF for Asia is now China. They'll go to China first, because China has $3 trillion worth of reserves. So they've got all the capacity in the world. They did not hold toxic assets for a variety of reasons, policy and just conservatism. And they're much less leveraged economies. So here's the growth bounce back. Now looks like it's going to be even more striking. And here, this will strike you. These are the levels of sovereign debt in the advanced countries and the emerging markets. Emerging markets going down and staying down, even with a fiscal stimulus response in some of them, and all of the advanced countries rising sort of dramatically and dangerously. Now, it's hard to overstate how different this pattern is from anything that anybody expected up until about 2005 or even later. But that's the world we live in. These are economies that are not in danger, not stripped of their capacity to invest, not driving without a spare, to quote Arminio Fraga, meaning driving through the desert without a spare tire, which is what most of us are doing now. And so this is a very different world, and some of the economic power comes from those things. I think from a business and investment point of view, the central question is, can the emerging economy sustain these levels of growth if the environment they're living in for an extended period is slow, difficult growth, with relatively fragile economies in the advanced countries? If you asked that question 10 years ago, the answer would have been no. There was no way the emerging economies could sustain this growth if we weren't generating the incremental demand to do it. And now it appears, no, there's some disagreement about this, but my view and the evidence thus far is it is sustainable. They are emerging with pre-crisis levels of growth or above. They emerged in speed, in order, China, India, and Brazil, probably the three most important, systemically important countries in the world. They are trading with each other. Their economic mass is larger, and their wealth is higher, so what they make, the goods and services they produce, is better matched to the demand. People don't normally think about that, but in a poor country, if you look at the demand side of the economy, it consists of housing, food, fuel, and not much else, right? I mean, they don't buy, iPads and stuff like that. But the large emerging economies now do. And the middle classes are growing very, very fast. So this is really a very, very big change in the global economy. It's called partial decoupling. And to calibrate it for you, I don't have time to spend a lot of time sort of, on this. So the question is, how decoupled are they? And the answer is, if we struggle along, they're decoupled. If Europe or America or both takes another big downturn, which implies subtracting aggregate demand from the global economy, they will not survive that. That is, they'll survive it, but it will slow their growth. So somewhere around where we are, if we just muck around and don't grow very much, which looks like about what's happening for the moment, maybe a little better than that, they'll be okay. If we go, that will cut enough out of demand that they cannot replace it with the aggregate demand that they're generating by their growth. Plus or minus, I think that's fairly accurate. You've seen this before, so I don't need to do that. I will spend a few brief minutes on China's transition. For those of you who are interested, and I know many of you read and speak Chinese, there's a document. There's a document that I was helped lead a group that responded to a request from the Chinese government to provide international experience and external input to the creation of the 12th five-year plan, which is the operating game plan for the Chinese economy starting about now. It was adopted in March. I have to pause at this point and tell you, I can't tell you the number of times, at least in America, where I've said the 12th five-year plan, and somebody sticks up their hand and says, I didn't know they had a plan. And I think, oh, crimps. So this is not a plan in the centrally planned economy sense. This is what those plans have evolved into. India has them too. And what they are is kind of policy priorities built around a shared understanding of what's supposed to happen structurally in the economy. It's something we should do more of and don't. Because once you get all those pieces in your head, and they really do get them in their head, then it makes it a lot easier to sort of figure out what's missing and what you should do on the kind of policy front. It even helps understand where the business opportunities are likely to lie. So China's entering what's called the middle income transition. That's the transition in which you reach middle income levels, and one very important thing happens, and that is the labor-intensive industries, which were the basis of your competitive advantage, for all of the time up till now, aren't your competitive advantage anymore. So they disappear, meaning they go to other countries. And so you have the destruction part of creative destruction at the economy level starts to really operate. And there's a very powerful tendency in countries to think, gee, we can't lose all those industries. And so they intervene to keep them there by subsidizing them, by forcing the exchange rate down, and that kills growth. Why? Because I've left you one main message tonight, is that this kind of growth is almost the same thing as structural change. You stop the structural change and you won't grow. You do not grow by doing the same things you were doing yesterday, a little bit better. You grow by changing where people live, by changing the structure of the economy, and this just happens to be one phase of it. This is pretty well understood in China, although there's internal resistance. The export sector, the labor-intensive part in apparel, is pretty powerful now, even in a pretty autocratic economy. So they could, if their power gets great enough, they could get policies adopted. Fastest way for China to sort of stop this process would be to sit on the exchange rate for too long. So there's this delicate balance between going too fast and too slow. One of the things that's going to help China through this transition is that as of last summer, they had suicides in the company that makes a lot of the Apple products. It's called Foxconn. And so there's a complete change in the sort of structure and rate of increase of wages and incomes in the export sector. And that very rapid rise in wages that we're starting to see will do two things for China. One, it'll force these things out of business eventually. They'll go inland where it's cheaper. They'll go down the coast. They'll go to Vietnam. Eventually, they'll be gone. And this is not new. I mean, I was in Korea in 1985, and the journalist kept asking me, Korea had a very high-quality, low-cost manufacturing operation. A lot of the shoes you wear came from there, a lot of the apparel. And the journalist came and said, wow, our wages are going up. And I said, yeah. And they said, well, it's going to put us out of business in those industries. And I said, yes. And they said, well, you got to stop this. And I said, no, wait a minute. I thought the purpose of this whole exercise was to have incomes going up. And they said, oh, yeah. And Korea is now the best case of managing this transition. For people who want to go back and understand how it's done, they just shifted the economy. They let those things go. In fact, they not only let them go, the entrepreneurs that ran those businesses are the ones that are running the businesses in Vietnam and Korea, transferring the technology that's embedded in their heads. That's part of it. The hard part of the Chinese transition is the demand side of the economy. Now, if we had, time, a lot of time to spend on China. China is an economy that has driven its growth from external demand and investment. And partly because of the W. Arthur Lewis effect, until last summer, the household income in China, which they know increasingly is going to have to drive the growth. It's going to have to come from domestic sources, and the economy has got to respond to the composition of domestic demand. And what they're doing, and what they did in the crisis, is try to keep the old model by having not much household income and then a huge investment component, some of it driven by public sector investment or the state-owned enterprises. And what's going wrong with that model is in order to drive the growth, they're making investments in both sides, government, state-owned enterprise, that are starting to have, not all of them, but enough, that are starting to have low returns, right? And it's a trap. Why is it a trap? Investment is aggregate demand. It looks like you're fine, but the reason it works, when the engine's running, is because the returns are high and if you like, the intertemporal multipliers are big. If you invest at very low returns, private or social just means things like infrastructure, which it's hard to measure, but you're doing a lot of good. And you get indirect effects through the rate of return on private investment. If you do that for long enough, you'll stall. And so they know this now, but now they've got to reconfigure the economy so the households have more income, the state-owned enterprises don't get to keep it and invest it on autopilot. I mean, to tell you how extreme it was, in the middle of the crisis, they discovered the state-owned enterprises are about more than half the net fixed assets in the economy, and the government owns large fractions of them, well over 50%, even if they're traded. And they make a lot of money, and they don't know what to do with it. So that's where a lot of this low return investment. In the crisis, they were speculating on real estate until the government caught them and told them to stop it. Why was that not a good idea? Because they've already got an asset bubble in the real estate side associated with the inflow of capital from the advanced countries in those low interest rate environments that we have, because theirs are much higher. So there's just a lot of complexity. In the course of this, they're going to have to get rid or start to get rid of the current account surplus. And the good news there is that their interests and ours in rebalancing global demand are the same. That is, there's no reason to run a current account surplus. There's no strategic benefit from it at all. So if they can get rid of it by increasing household income and lowering the household savings rate through social insurance and social service provision, that was all to the good. So that's where they are. These are the countries. This is a picture of a bunch of countries entering the middle income transition. And what's striking about this is this. Most of them stop. In fact, there's 5 countries that have gone through the middle income transition and kept the growth up. Now, you might question Japan. Japan actually got through the middle income transition quite nicely. They stalled out later at the end of the 1980s with a massive asset bubble that burst, leveraged asset bubble, worse than the one we just went through. Korea, Taiwan, all Asian, 2 city-states. Finally, if I haven't bored you too much, I want to talk about the fact that one of the things that is starting to happen, and I don't think much attention has been paid to this, is that these economies are now big enough and far enough up the value-added chain to start to have an impact on the structure of our economies. And the one I've studied in detail is the United States. So let me just flip. So in the paper I showed you a picture of on the 3rd slide, my research associate, Sandile Halachwayo, a South African born and raised in America because they had to leave because of apartheid, very talented young person. We looked at employment and value added in the United States economy over the last roughly 2 decades coming into the crisis. What is value added? I don't know if that concept comes up in the MBA or the executive education. Value added is the value of what you make and sell minus what you have to purchase to do it. So it's the value contributed by labor and capital. If you add together what you pay to the workforce, including the executives, and the return to the owners of capital and add in the amount the government takes in taxes, that's value added. And it's true for an enterprise, it's true for an industry, and so on. So we're looking at value added, and we're looking at, and if you add value added up across whatever it is, and add them all up, without double counting, you'll get the GDP of the country. So it's a clean measure. This is a picture of employment in the United States. The critical part of this little bit of research is we took the industry data, fairly finely defined and separated it into a tradable part and a non-tradable part. What's that? Non-tradable means it's goods and services that have to be produced in the place that they're consumed, meaning the country. What are examples? Government, construction. Most buildings are not made in another country and then shipped in. Retail, hotels, foods, restaurants. Get the idea? And then the tradable sector is things that goods and services that can be produced in one place and consumed in a different place. And of course, the thing that draws so much attention is the service component of that is a very rapidly, small, but very rapidly growing part of the tradable sector because of technology and management expertise, the India effect. So in this period of time, the United States, that's a picture of the economy in terms of employment. And if you ask where were the jobs created, the answer is the United States created over this 18-year period 27 million jobs, and almost all of them were in the non-tradable sector. Kind of interesting, isn't it? And if you look inside that, I'll skip ahead and see if I've got it. Yeah. This is a big employers. I apologize that the graph got knocked out. All right. The top one is government, biggest employer in the economy. It grew 4 million jobs. This is healthcare. Now remember, American healthcare is really screwed up. Okay. This started at 10 million and got to 16 million. That's the single biggest increment. 6 and 4 is 10. Almost 40% of the jobs net, okay? I mean, jobs are created and destroyed all the time in every sector, as people try things out and companies go out of business. This is net additions. For almost 40% of the job creation in the United States economy was in two sectors, government and healthcare. If you add in retail, food, accommodation and food and construction, which turned down, as in 2006 when we were coming into the crisis, you've got a very large fraction of the employment in the United States. Now let me flip back. If you look at value added, you see a different picture. I mean, this graph doesn't tell it, but it turns out that value added is growing in both sectors at relatively similar speeds. In fact, the value added in the tradable sector is growing, notwithstanding the near zero growth in employment, at a slightly faster rate. So in bar graph terms, value added looks like this. And that wouldn't shock you or, sort of make you sort of sit up and. Then if you look at, this is the logarithm of the value added graph, so you can see the slope of the blue line is slightly higher. That's the higher growth rate. And then if you look at value added per person employed, they started out fairly close together. Down here, non-tradable, tradable. Non-tradable is much bigger, global, economy-wide average. And then they sort of trailed along, and then there's clearly an inflection point right around the bursting of the tech bubble. And value added per person in the tradable sector took off. Why? Because value added was growing, and employment wasn't. So it's basically all the growth in value added is growth in value added per person employed. Now, if you stand back from this and ask what the hell's going on, the answer is fairly simple, right? The employment was created in the non-tradable sector for reasons I'll come to in a minute, and that is the sector with low growth in value added per person. That's very closely correlated with income. There aren't that big differences in the capital intensity across industries, and there are exceptions. Mining, utilities, very capital intensive, so that what I just said would be false for those two. So basically what we did is we put everybody, incrementally into the labor force, into the non-tradable sector where we don't have to compete. We probably bid down the wages. Now, why did we do that? And the answer to that is the global economy is taking, for purely competitive reasons. There's nothing wrong with this in terms of market. There's no market failure. The global economy is taking the lower value-added parts of the value-added chain. If you look at it in industry, you'll find it. And therefore, what you see when you look at the tradable sector is you see highly paid people in the upper part of these global supply chains or value-added chains, and they're doing fine. They're people like all of you. You're highly educated. You work for companies that increasingly operate multinationally. You have a sandbox that's getting bigger and bigger and fun to play in. It's just that there's another subset of the population that isn't. And so my best guess, at least for the American economy, is that we're about at the point where growth and employment are going to diverge. And if they don't diverge, it'll be because the labor market clears, and then we'll have an even worse income distribution problem than we already do. Now, at this point, usually people say, well, what are you going to do about it? And the answer to that is we don't know. We wrote this to start a discussion which wasn't happening, and it appears to have worked. There are obvious things. Fix the underinvestment in infrastructure, fix the inefficiency of investment in education, focus again on the knowledge and technological, and particularly the public sector investments of the economy. But it's quite likely, in my view, that an open global economy will actually have, distributional impacts. And that's coming as a surprise to people because if you go back at this first 50 or 60 years of the century I was talking about, what you discover is that the distributional effects were pretty benign. The advanced countries grew at 2.5% on average and didn't have unemployment problems. And the developing countries, after stumbling around for a while, started growing at rates, and literally hundreds of millions of people are no longer poor. It's hard to complain, about that. That's a little too simple, but it's about right. But now we're at a point where they're much bigger and further up the value-added chain, and it looks like they're starting to provide both price effects and employment effects on the subset of the population that worked in the middle to lower income part. Rather than answer the question, what are we supposed to do about it, what I say to people is, we're going to go study other countries. And my favorite, and the one we're embarking on now, is Germany. Because Germany doesn't look like this. Germany has a very different income distribution. They have an advanced manufacturing, industrial machinery export sector that's generating a trade surplus, unlike this. And they've gone through a process post-unification of thinking about their competitive status in the world and acting on it. And it looks like key components of that, from a distance, admittedly. When I come back and talk next year, I won't be invited. I'll tell you what we found. But it looks like they got rid of a lot of the rigidities in the labor market, and then they leveraged what is usually reviewed as an institutional set of disadvantages to make a choice. And that, it looked to me like they made a choice between employment and competitiveness in the tradable sector and the rate of increase of wages and incomes, and they chose employment. It's pretty clear. And if you look at the rates of increase of wages and incomes, they're pretty muted for the last 10 years. Well, we'll know more about that later. In the meantime, I've also got McKinsey Global Institute to do this for the entire collection of systemically important countries in the world. So we'll have a lot more data for you. But I think part of the challenge in getting through the next little while, maybe 15 or 20 years in the global economy, is that we're going to have to learn to stop thinking about only efficiency issues and market failures and start thinking about distributional issues. Or people are going to start getting off the boat, and it will show up in the political choices that we make, and ultimately it will threaten the openness of the global economy. So I think it's not a bleak picture necessarily, but it's one that is probably different than experience. And this would be under the category of this is a one-time journey. We haven't done this before. And it's certainly not a cyclical, challenge. I mean, this is fundamental structural change in the global economy that's being driven by very powerful forces and we're only going to take this journey once. Well, that's enough for me. Floor is open for questions. Or dinner, or whatever.
Yeah. Well, thank you very much.
Thank you.